Okay, good morning, everyone, and welcome to this morning's edition of the Coffee Microcaps morning meeting. We have another results webinar here for you this morning with two companies joining us, both returning companies as well. I will just quickly run through these intro slides and then we're going to get straight into it with our first presenter. My name is Mark Tobin. I'm the founder of Coffee Microcaps. For anybody who is joining us for the first time here this morning, you're very welcome. And all our regular attendees, welcome back. I would like to mention RAS Research Service, our sponsor here for all our events at Coffee Microcaps. If you are looking for research on small and microcap names on the ASX, please do check out their website. There is free content on there, and they also now have a new paid subscription service for additional content in this space if you're looking for it. I'd also like to mention our upcoming conference in Sydney. We still have a few seats left in the room for the Sydney conference happening Tuesday the 16th. So that's Tuesday week. Please check out the event on LinkedIn if you do want to register for our upcoming conference in Sydney. A quick welcome to our friends from ASIC if you're joining us this morning. For anybody who is joining us for the first time, companies we tend to have on here capped under 300 million in revenue, approaching cash flow break even, or indeed already profitable. We tend not to have companies from the resources and biotech sectors on here. So what I like to call industrial microcaps, which covers everything else from healthcare, financial services, industrial products, professional services, retail, anything else really. Structured this morning's webinar, we've got two companies presenting 30 minutes each. We'll try and break it down into a 20-minute preso and 10 minutes of Q&A. If you do have any questions, please type them in the Q&A box rather than the chat function. Just makes it easier for me to moderate the questions to our presenters. And please note the webinar is being recorded and will be up on the Coffee Microcaps YouTube channel on Monday. Follow us pretty much all of the main socials, Twitter, YouTube, as I said, for the recording of this and indeed our recording from last week when we had 5 companies presenting, LinkedIn, and I do a monthly newsletter which will also be going out on Tuesday of next week. You can get that on Substack. Our first presenter this morning is going to be Mathew Cherian, MD of Global Health. And then after that, we're going to be welcoming back Rahul, Guha, Executive Chairman of Fiducian Services and Group CFO of Fiducian Group. But that is enough from me. So I am going to stop sharing my screen and hand you over to our first presenter this morning. Mathew, if you would like to share your presentation, I will let you know once it's coming through there. Yeah, it's just
All
loading,
good.
Mathew. Yeah, I can see the cover slide of the deck now, Mathew. You can take it away whenever you're ready.
Great. Thank you very much, Mark. And to everyone that's in attendance, thank you for giving us the time. Um, while this disclaimer is being absorbed, I'll just tell you a little bit about myself. I have a Bachelor of Business degree from WA with a double major in information management and information technology. So I've been managing software development since 1981, which is when I graduated. Um, through multiple economic corrections and multiple technology disruptions, if you like. I founded a software company in Perth in 1985, which is now part of Global Health, and I am the largest single shareholder with just over 42% of the company. Um, a little bit of a snapshot on the company. The company listed in April 2000 as Working Systems, which is the company that I started in Perth, and it provided software development services and consulting services across a variety of industries. So it was not focused on healthcare. A key project in our early years as a listed company was the development of a territory-wide mental health application for the Australian Capital Territory, ACT, in about 2002. And this influenced our strategy going forward quite significantly because the software was deployed across multiple delivery settings from public hospitals and private hospitals through to triage, help desk, uh, individual psychiatrists, psychologists, of the Department of Housing and Centrelink. So, and the patient was a key part of the care plan going forward. So what you had was, what dawned on us was the fact that you had a team of multiple disciplines working with the patient who have generally a lifelong condition, and you got to share information across all the providers and the patient. And that influenced our thinking quite significantly. So in 2008, the company refocused as a pure health technology business focused on clients living with lifelong or chronic conditions such as mental health, alcohol and other drug addictions, uh, diabetes, hypertension, basically lifelong conditions. The company name was changed to Global Health in 2008 to reflect our single focus on healthcare applications. Sorry, I hope you're not hearing that beep. Um, so our healthcare solutions were desktop applications built over 20 years ago. In 2022, about 3 years ago, with the emergence of software as a service or SaaS, the onset of COVID, and the development of AI as a major disruptor, the company commenced on a major technology upgrade project to position our customers for the next decade of technology disruption. Over $8 million in R&D was expensed over the last 3 years, and this has impacted our financials in the short term. But we are pleased to say that we are trending back to positive operations and positive cash flow. With just under 59 million shares on issue, our market cap is about $5 million on customer revenue of 7.5 million and annual recurring revenues of 6.3 million. So I'm pretty motivated to get the price up, obviously. The development project objectives was to consolidate our 3 provider applications from 20 years ago, which was a PAS for hospitals, electronic medical record or an EMR for community health, and a primary clinic application, which was mainly for primary care, specialists, allied health, and GPs. These 3 applications have been consolidated into a single multi-tenanted um, architectured SaaS platform, which we call Mastercare Plus. In addition, we also invested in consumer engagement and empowerment applications, which is our Hot Health Patient Portal and our LifeCard Personal Health Record, to fulfill our vision of connecting clinicians and consumers. And this project has laid the foundation for the incorporation of AI features across our portfolio, a process we commenced earlier this year. Now, a little bit about the healthcare landscape. Healthcare is a universal global service affecting all people. The Australian pain points of escalating demand for services and escalating costs reflect the global landscape: an aging population with increasing demands for services, a growing incidence of chronic disease and lifestyle conditions, which typically affect us for the rest of our life, increased cost of treatments through better medications, better devices, a huge impact on productivity for employees, for employers, due to the mental health and other health issues of their employees. Approximately 30% of healthcare expenditure in Australia is not patient-facing. That means it's dealing with paper forms, managing patients, and workflows and clinician workflows, reporting to regulatory bodies and claims processing. There is recognition that technology can help drive costs down and improve the management of health and wellness. Now, focusing a bit more on the Australian healthcare market. Over $200 billion a year is spent on healthcare. Excluding the public sector, the private sector accounts for 73.8 billion, of which we as citizens are out of pocket to the tune of just under 40 million. The insurers are funding us to the tune of 20 billion, and other private sources such as the TAC and workers' comp another 15 billion. It's a huge market and is expected to reach $2.2 billion by 2030. Growth in healthcare demand impacts all funders, such as the Commonwealth Government, state governments, and private health funds, who are struggling with rapidly rising costs in staff, interest rates, energy, and general inflation, as evidenced by recent results across the sector. This, in turn, impacts the service providers who are asked to do more with less. What uniquely differentiates us from the competition is that we cover the entire patient journey, from the initial diagnosis through to treatment in a clinic, treatment in a hospital, treatment in a community health center, and through discharge, treatment in the home. Through our 4 applications, Mastercare, which is for clinicians, it can be configured to support something as simple as referral management through to hospital clinical systems, inpatient EMRs. While the hospital sector has been struggling with inadequate funding, our broad portfolio enabled us to refocus on other segments, such as referral management and team-based care solutions for mental health, alcohol and drug addiction, and other multidisciplinary services. We value-added our core provider applications with ReferralNet, secure messaging, and Hot Health patient engagement platforms. In the current financial year of 2026, we will add a new revenue stream, supporting consumers to better manage their health and wellness, offering our LifeCard personal health record to existing service provider clients to give them a totally integrated ecosystem. So in summary, and looking forward, in the last 12 months, our R&D expenditure has reduced from 2.2 in F23, 2.7 in financial year 24, and 2.1 last year. We are budgeting for R&D expenditure to further reduce to about 1.7 million in this financial year, which will free up a lot of cash to be spent, a lot more cash to be spent on sales and marketing. In fact, for the 2 months to August this year, we are already 100% above the 2 months to August last year, with a strong pipeline of future sales. We are also expanding sales to new existing customers and partner channels. We have signed an integration partner agreement with Best Practice, which has roughly about 65% of the general practice market in Australia. We are also a core member of the La Trobe University Care Economy Collaborative Research Center, which has about 50 to 60 different partners, generally service providers. And the focus is to trial our portfolio, including, of course, our consumer health record, in a government co-sponsored 10-year trial. We're also developing a new healthcare consumer revenue segment by leveraging our existing service providers and giving them access to LifeCard. We've engaged an AI delivery manager to exclusively implement AI across our internal processes to do more with less. We are also developing artificial intelligence add-ons and are discussing integration with a number of third-party AI providers to include their features in our healthcare platforms. In summary, we're targeting a return to profitable operations and positive cash flow by June 2026. So with the macro tailwinds, as I mentioned, of rising healthcare costs, aging population, chronic disease growth, and innovation pressures globally to adopt technology for improved outcomes, we feel we are very well positioned to turn things around this financial year. Finally, our board, Grant Smith, is been involved in healthcare since about the 1980s, initially doing the corporatization of hospitals, which was subsequently sold to Main Health and then Ramsay and Healthscope. Steve Pint is a commercial lawyer and an entrepreneurial CEO, and he has been with the company for 25 years, so he knows healthcare really, really well, and myself, whom I've talked about before. So with that, I'll hand you back to Mark, I guess.
Thanks, Mathew. Yeah, we had a couple of questions that were emailed in ahead of time. One of the questions, I guess, is, as you talked about, the business has been listed since 2000. We're now in 2025, and there's been various iterations over the time. Just a question of, does it kind of make sense to, keep the listing at this point, given how long it's kind of been there? And the kind of second thing is a kind of a follow on from that was management's confidence at this current point in time of, as you alluded to in your last slide there, getting the back to cash flow positive, back to positive profitability. I think they're trying to get a sense of, what has changed in the last 12 months to give you such confidence moving forward.
So in the last 3 years, really, we have almost completely refreshed our team. Uh, and the bulk of our leadership is actually in the 25 to 35-year-old age group. So we've refreshed by putting in some young talent who've known nothing other than the digital world all through their lives. In the earlier question, it's about competence, right? Not confidence. So
No, I think they're just
um,
kind of saying, you've been listed for kind of 25 years, and they're just wondering, does it still make, given the current size, does it still make sense to kind of be listed?
well, I mean, we started on this journey really as a health provider in 2008. I think what took us off track a little bit was um, the My Health Record initiative of the government, which has proven to be less than successful, if you don't mind me saying so.
Hmm.
Um, and so we see a real opportunity in actually setting out to do what we originally set out to do, which is to empower consumers. If you look at our website from 20 years ago, our ASX announcements from, say, 2008, you will see Connecting Clinicians and Consumers as the tagline for well over 12 years. In that 12 years, the public sector has spent and tried to almost dictate how technology should be applied in health. I personally don't think it's been very successful. COVID changed people's perceptions, and the use of video consults and telehealth and online consulting means that we're at that special point in history where our portfolio actually has a huge relevance to the state of the market. So that's why I think we persist in what we're doing. Public versus private, well, I guess we always have uh, people that suggest we should go private, but generally the valuation tends to be based on our share price. And with a share price that's less than 1 year's, 30% less than 1 year's revenue and probably 10% less than 1 year's recurring revenue, the conversations don't go very far. If we were to privatize it, you're basically putting the company on the market, which it is already anyway.
Hmm.
So I'm not sure what advantage there is in privatizing it. It's already on the market. It's already for sale every day.
Yeah. Okay. The second question we had emailed in was one around pipeline for new contracts and stuff. I think we've seen quite a few contracts come through in the,
Yeah.
let's say, the last quarter of FY25, and just a question on because we've had. I don't know if we call them a competitor to you, but operate in the same space. We've had Kate Quirk from Alcidion on here a few times, just on the dynamics of bidding for contracts, winning contracts, when you're bidding on work, how how many are successful in terms of, if you bid on 10, do four kind of come off and you lose four to a competitor, and two maybe end up going on hold by, they say they want a contract, but then actually they've realized, no, we're not ready for what we thought we wanted. As I find a lot with these like big government contracts or enterprise contracts, they want it, and then the major bid on it, they're like, no, we're putting it on pause for 12 months.
Okay. So the first thing, yeah, first part of the question is about competitors. We don't believe there are any competitors out there that have got this patient-centered portfolio. So Alcidion, for example, work in hospitals. So do we. But we tend to be in hospitals that probably in the private sector rather than the public sector. And they tend to be focused on either mental health conditions, diabetes, with theaters, with beds. So in the hospital sector, we tend to come up with a different set of competitors to the primary care sector. where we might be up against, the dominant players in primary care, such as best practice or others. In the patient engagement platform, we might be up against a different set of competitors again, which is Health Engine and HotDocs. And in the secure messaging, our competitors might be HealthLink and Medical Objects. So in each of the sectors of those four solutions that I mentioned on the slide, we have a different set of competitors. But the distinguishing factor is the fact that we are very much focused on consumers living with lifelong conditions. So the demand for our products tends to not include these other normal players. And the second part of your question, we do tend to win a fair amount of the tenders, sort of the opportunities that we get because of that unique fact that we've got the end-to-end patient journey covered from initial diagnosis through to treatment in a community health center, treatment in an acute center, treatment in a home. Uh, and interestingly, in the last 3 years, mental health has become an epidemic. We all know people that have got family members that have committed suicide. It's a huge epidemic. And that's generated so much demand for our applications because 50% of our customers are actually service providers to the mental health and AOD, alcohol and drug community segments of healthcare. And that sadly are the growing components of healthcare. Um, and the latest thing that's generated demand for our platforms is the regulations that um, ask employers to take better care of their employees. The banks, the mining companies, the large employers have got obligations to make sure that their employees are well looked after. And that's actually opened up a whole new segment. Um, and I think there'll be some announcements in that area pretty soon. So we're not just in the traditional healthcare world of hospitals and clinics. We are in the wider healthcare opportunity of consumer health and supporting the providers of service providers of healthcare is just a key part of providing better outcomes for patients in terms of their health and their wellness. Hope that makes sense.
Yeah.
So, yeah,
Just another one on the R&D. You touched on it that it's been coming down, and you're kind of looking at maybe that 1.7 mark or whatever. Is
yeah,
that because you've gone through a big stream of work and
yeah.
the kind of heavy lifting is done, and that kind of 1.7 is kind of steady state for the time being? Or should we, if you look out another 1 or 2 years, should it drop to maybe 1.4, 1.5?
I, I, I think it will drop. And it's not because we don't want to invest in technology, but it's because AI is very low touch. So you can do things with AI. I mean, our guys are talking about 15, 20% savings, right? And we are just a
Mm,
software house. So we've actually invested a fair bit in agentic AI for our internal processes, so that a lot of stuff that was manual is now done automatically, and we're implementing that into our platforms as well. So I think 1.7 this year with AI, it should drop to probably uh, 1. It should drop. I don't want to guess a
mm,
number, but the industry standard is roughly around 15% of revenue. So if you look at our revenue of 7.5, we were spending over 20%, right? And the
mm,
previous year we spent much more. So we want to bring it back down to about 15%, which is industry standard. And because we're in the tech field, there's no choice, right? You got to maintain your asset. We expense it all. So if you take away the money we spend on R&D, our operations are generating a couple of mil, or
okay.
1.5, 1.6 mil on 7.5 million of the turnover. Yeah.
And in terms of customer wins are in the pipeline, if we can just go back to that.
Yep.
Um,
Yep.
is it more in the mental health side, or is it right across the board, in terms of you know, the diabetes one is, is mental health
Yeah.
what I'm trying to get is that like the real driver of growth? When you talk about being up 100% on the first 2 months of FY26 versus the same period in
Yeah.
FY25, is that really all being driven by mental health programs, whether being rolled out at community level or in some of these like workplace health programs?
It's actually mental health and workplace programs
Okay.
that's generating a lot of demand for our stuff. Um, it's not because otherwise the rest of the sector is fairly computerized. It's a churn world. If you win some, somebody else loses. I have this big passion about saying that importing overseas applications is importing overseas systems of delivering health. And Australia has been rated in the most recent Commonwealth report as the best performing healthcare system in the world. The US was 10th. New Zealand, Canada, everybody was below us. And yet we tend to import a lot of applications and therefore their ways of doing things into our healthcare system. So I think there's a huge opportunity because of the pressures on cost. I don't think healthcare providers can afford these costly overseas systems anymore, which I think need a lot of tweaking to support the Australian healthcare system. So I do see that as also another driver for growth for us. The fact that we are unique in the healthcare world because we have that mix of multiple funders, which the developing economies of the world in our neighborhood, if you think about ASEAN as our neighborhood, they don't want another, they can't afford an NHS or a HMO or a single funder systems. They need the Australian model of 40% private, maybe 60% public. Probably in ASEAN or developing economies, they divide it into three tiers: the lower tier, the middle tier, and the top tier. And the top tier have to pay for everything, which is fair enough. The middle tier gets a bit of subsidy, and the lower tier gets subsidies. And our healthcare system supports that model of healthcare, which is the way the world's got to adapt really to address this escalating demand and escalating cost situation, in my view.
And maybe if we just follow on from that, in terms of those big international players, I mean, how hard are they going at the Australian market in terms of, bidding for work and pricing it appropriately so that they do, get their foot in the door and try in a land and expand strategy, if I can use that phrase.
Yeah. In in the public sector procurement, they tend to dominate because certainly the state governments of the last 15 years have been tended to be centrally one size fits all. So instead of, in the 90s when we were doing bids for hospitals, we'd be dealing with boards of individual public hospitals or regions, Gippsland or Bunbury or whatever. But then when you centralize it and say we want one system to run the whole state, whether it's the Alfred or a small aged hospital in Wodonga or something, and you think one system fits all, it doesn't work. It doesn't work. So the public sector has got this, but if you have one size fits all, then the projects become 200 million, 300 million. And that's when we can't compete because our balance sheet goes against us. So we focus on what we can win, which is the small end of the market, smaller end of the market, I should say, or the private end of the market. We do have public hospital clients, but it's not their core system. It tends to be referral management or mental health services within a public system, but not for running the whole theaters and beds. And that tends to go to the US, large multinationals who developed their systems in the 80s, by the way. So that gives us another opportunity because we've invested in this R&D. We feel that we'll be able to leapfrog these old, clunky, large monolithic systems that have got good market share and therefore a real challenge to maintain that market while they migrate into AI-enabled systems. It'll take them time. And if they can do it, they would much rather focus on their home market than they will on periphery markets. So that's how we got into health. When we had the recession we had to have in 1993, a lot of the multinationals pulled out of Australia because it didn't make economic sense. And that's how we ended up winning deals for WA Health and SA Health. And that got us on this journey in the health sector. Otherwise, a lot of our clients being in Perth were obviously mining and Wesfarmers and Wilson Parking and those kind of guys, right? But the recession we had to have actually was significant for us, was a catalyst for us getting into health. We just feel that health is still there, ready to be transformed. It just hasn't been radically disrupted. And every other industry gets disrupted by consumers, not by incumbents. And that's the edge I think we have.
Okay. Mathew, if we can just quickly answer this one last question. Overseas opportunities, are you looking at any of those at the moment, or is it there's enough kind of going on in the Australian context to keep you busy?
We do get a regular interest from overseas uh, parties, uh, and but because we've had a overspend on R&D, if you like, we've had to be careful not to stretch ourselves too thin. So yes, the overseas markets are definitely on our radar, but first we've got to get to cash flow profitability and yeah, positive cash flow and be able to afford expansion. I think if we expand overseas, it'll be through channels. But again, because we're talking about a cloud-based software as a service, the cost of expanding overseas is no longer as huge as it was before SaaS, where you had to
Mm.
have partners everywhere because you're implementing systems locally on the on-prem, if you like.
Yeah.
Now, when we decide to go overseas, we just have to spend money on marketing,
Okay.
tech marketing, I should say.
Mm.
So I think it's a huge opportunity, and healthcare is a universal product. The way you treat um, diabetes in Turak is the same as it is in Timbuktu, right? So we do have a global product, and it's only a matter of making sure that we walk before we run and run a measured approach to how we expand.
Okay. Mathew, we're just up on time, so we'll leave it there. Thank you very much for joining us this morning. And hopefully, we can get you back in maybe in early 2026. Uh,
Sure.
if I can just please hand over, if you could stop sharing your screen there, please, Mathew, and we'll hand over to Rahul Guha from Fiducian. Rahul, good morning.
Yeah, good morning, Mark. And we have got Indy Singh as well with us, who's the executive chairman of Fiducian Group.
Indy, thank you so much for joining us. A bonus attendance here with us this morning. Um, if you want to bring up your screen, please, Rahul, or your presentation, and I'm just going to fix up your name tag. For some reason, it's coming up with our previous presenter. So let me just fix that quickly.
So while you're doing that, Mark, if I can please request Indy to kick off, maybe just if you can please share an overview for our audience today, Indy.
Yeah, sure. Thanks, Rahul. As your audience might know, we are a financial services business. We have a financial planning business, and that's basically the ones that drives inflows. We have attached to that a platform which administers client accounts in superannuation and non-superannuation money. And we also have our own multi-manager funds where we choose underlying fund managers or different fund managers and combine them to manage the money for our clients. That's basically the platform and the building blocks. Now we listed in 2000 and we've been going since then. We've had some reasonably good results. Last year, if you'd like me to talk about it, Mark.
Yep, please go ahead.
It was rather a strange or a difficult year. We had an election, which when the elections come, I've noticed from my experience, clients stop. They don't invest. They just sit on the fence waiting for what the outcome will be. So that came along and early part of the year. And then there was always the Ukraine war, which doesn't seem to want to end. And things were starting to at least get okay and come along. And then the tariffs hit. And our market, along as if you know, the US market between February, March, and April fell about 17%. So our reason for existing is that when we have assets under management, we charge a fee on those assets. And when the markets fall, the asset values fall. So the revenue gets truncated or reduced to what it was before. So between, I'd say February, March, April, or only around mid-May, because the assets grow day by day by day and month by month, not at one fell swoop, we started recovering the income. So our expectations were higher, but even so, I think we worked through well. We delivered a net profit after tax of about 18.6 million, which was about 23% above last year. And also compared to the previous year, the underlying net profit after tax increased by about 13%. And so did the earnings per share grow by about 19%. So our dividends have also been responsive to that. Though someone who had come in about 2012 to Fiducian and put $1,000 in would today be receiving over $400 fully franked income a year, plus the share price increase. So we've done well for our shareholders, and at least I think reasonably well. I won't say really well. And especially for people who are on an account-based pension and who have held the share, are finding that it's been very beneficial to them for income. So that's basically from me as a snapshot. I can leave it to Rahul to go through the details, and I'm happy to answer whatever questions that may come up.
Thank you, Indy. And thank you, Mark, again, for giving us the opportunity to share results and story with your client base. Just looking at as Indy touched upon, three main lines of businesses: platform administration, funds management, and advice. And in last financial year, the platform administration has performed quite strongly. We had roughly about $343 million in net inflows coming from our salaried and franchise advisors. And almost 100% of the inflows are also going to the second part of our business, which is the Fiducian funds. So last year, the average in last year, in 2025, the average was roughly about $3.785 million, $3.785 billion funds under platform. And when we compare that with the July end or August, that's roughly about 4.18 billion, which means that our starting point in FY 2026 has been about 10% higher compared to the average in 2025.
So can I just add that that's important? Why Rahul's mentioning that is because, as I said before, our revenue is generated through the growth in the asset value, and we charge a fee on that. And if the asset value starts the year much higher than previously, it's a good sign for us going forward because we earn that income going through the year.
Absolutely. Yeah. No, thank you, Indy. And in effect, if the market continues at the same level, even if there's no growth, potentially we could get roughly about $1.6 million additional revenue because of the head start that we have got in FY 2026 compared to FY 2025. So our platform, what we believe, is up there with any of our competitors. It's quite a leading edge technology platform, and we have got the functionalities built in to help the advisors not only for the efficiencies, but also protect the advisors and clients from the cyber risk. We have got multi-factor authentication in our system for the last 3-4 years or so, and we continuously spend roughly about $3 million each year to make sure that we are able to deliver the functionalities as well as the stability in the system. In addition to the core platform, we also have launched recently. We have also launched recently the Auxilium or Badge platform. And Auxilium platform is targeted towards the IFA part of the market. We have got one of the most competitive rates, one of the most low rates in Australia at the moment. The clients are charged about 20 basis points, which scales down to 0 after $1 million. So what we believe is that through this new badge product or this platform, we will be able to address some of the vacuum that has been created for the smaller end of the town, with advisors having $40 million, $50 million, $100 million, and so on and so forth. In last financial year, we were able to win some clients as well. And towards the end of the year, we have received a net inflow of 125 million odd, that takes the assets under administration in this platform as well as badges to 236 million.
So if I could just add that Auxilium is the additional platform. There's no white handing of the Fiducian platforms. It actually is available only to external advisors, external network. There's about, I think, 15,000 advisors in Australia, maybe 12,000 actually operating. And they can only use Auxilium. The Fiducian affiliated advisors only use the Fiducian platforms, where they get the Fiducian funds, and no one else can access the Fiducian funds if they're not using the Fiducian platform.
Absolutely, Indy. In last financial year as well as over the last 5 years, you can see the net fund inflows in our platform has been quite stable and has always produced positive net inflows. If we were to compare that with most of our peers, most of our established peers in the industry, all of the big names, they have necessarily have had net outflows, and we very much contrast with that. We have been able to deliver net inflows over the years. And as Indy touched upon, that inflows mainly has come from our own aligned financial advisors. However, having said that, we have got about 77 financial advisors that were able to produce $343 million net inflow last year. But then if you compare that with the IFA market, there's a potential out of the pool of 15,000, potential 10,000 smaller advisors could use our platform Auxilium, which opens up the horizon that we are targeting much broader compared to our own financial advisor network. So with that, we'll quickly look at the funds management now. Very similar story compared to the platform administration. Last financial year, the average funds under management was $5.512 billion. And we started the month of July about 7% higher compared to the average on the previous year. If the market stays where it is currently, or at the end of July, potentially we would have an additional revenue, annualized additional revenue, almost about $2 million, just for not doing anything else, but just having the head start, having the higher starting position compared to the average that we had in the last financial year. Funds management, our funds management business, we are multi-manager. Our investment team, we don't select stock. We don't select BHP. We don't buy BHP and sell Rio, but effectively we manage the 5.5 billion that we have got, or close to about 6 billion that we have got, through about 40 different fund managers and funds, both in Australia as well as in overseas. So we work through that structure. Our objective is not to shoot the lights out, not to have the outstanding performance, not to have the #1 fund manager of the year, but to produce a little bit extra returns compared to the average by taking a little bit less risk compared to the average. And when we have done over the years, you can see the performances on the screen. As an example, the diversified funds are capital stable, balanced growth. Balance, as an example, 10-year returns, second best fund manager out of 62 in Australia, 7-year returns, 4 out of 73. Very similar thing in growth as well, 17 out of 139, 7-year, 2 out of 130 over 10 years. And these statistics are July 2025, but Indy in his annual report has presented this time for the first time, not only July 2025, but just going back 10 years. And the results and the statistics and the positioning has been quite consistent, whether it's 2024, whether it's 2023, whether it's 2019. Over the long term, we have produced quite consistent and stable returns for our clients.
Yep.
We also offer a couple of specialist funds, Technology Fund and India Fund. Technology Fund last year produced a return of 22.4%. India Fund produces consistent return 9.1% over 10 years. What our advisors tell the clients is not to put all of their money into these funds, but a portion of their allocations go into these funds, which has got quite a potential of high returns, but also the volatility in the short term. Now, why would a client invest in Fiducian funds if they can access directly a BT share fund anyway? And why would the advisors use Fiducian funds as opposed to Pendle Fund or some other funds? The reasons are quite simple. I'll start with the advisors. So when a client sees an advisor advisor need to make sure that they are mitigating the risk for the clients and diversifying their asset holding. So essentially, they would need to research maybe 10 different funds, 20 different funds, 100 different funds, and then spread the client's allocation, as an example, Australian share fund, across different managers so that there's no single manager risk. What Fiducian does is that exactly the same process has been replicated in the form of the managed funds, which is multi-manager fund, which is, again, in this example, Fiducian Australian share fund. So if a client wants to invest $10,000, so currently the $10,000 will go to Fiducian Australia share fund, but then our investment manager, Fiducian's investment manager, will use 6 different fund managers and give them the mandates to manage the money. So essentially, clients' $10,000 gets managed by 6 different managers. It's not only $10,000, even if the client wants to put $100 into Fiducian funds, it still gets managed by 6 different managers. So the advisor, through these Fiducian funds, is able to give the diversification that the client is looking for. From the client's perspective, if they were to go to one of our single manager funds, in Australian share fund, they will probably pay a fee of roughly maybe about 90 basis points, 95 basis points. The fee that Fiducian charges is not dissimilar, very, very similar compared to the market. And the way we are able to do is through the scale that we have got. If we charge clients 90 basis points, we, again, as an example, will find a fund manager, a good fund manager who will be offering 50 basis points to manage the money for us. And as the scale grows, that 50 basis point could potentially come down. So essentially, Fiducian will be able to make a margin through putting this process together. And there's a natural hedge also. As the funds grow, there's the potential for the margins to increase. So currently, we have the profit before tax margin is about 54% of the gross revenue. Our fintech capabilities, Fiducian has got an in-house IT team, and that in-house IT team has developed a platform administration software and backend system, which is called Fast Track. We also have got Force, which is the financial planning software comparable to Xplan, and also Fiducian Online, which is the reporting system. We believe we are one of the very, very few, if not the only one operating in Australia, who's got the internal capabilities to provide the administration software, the financial planning software, as well as the reporting software, sitting under the same code, sitting on the same house, and fully integrated. What it does for an advisor is able to spend much more time with their clients, and through the efficiencies that we have been able to create through this integrated process. Towards the end of last year, we also launched a Fiducian mobile app, and we have seen quite a good and promising take-up on that. The final business segment is a financial planning, and financial planning is very, very core for our growth. And it's the way we look at this division is more of an enabler of steady flows to funds on the platform, funds in the platform, as well as under management. Currently, we have got about 77 financial advisors spread across 46 different offices all across Australia. We provide a target to the advisors. Last year, the target was 6 million for each advisors, but we also give a target for raising the fees from the clients. When we talk about the fees, the average fees in Australia is roughly about $4,200 for each client. Our advisors were charging $2,800 on an average in 2024. And as part of the initiative to raise the fees, we were able to raise it to $3,200 in 2025. But $3,200 contrasting with the industry average of $4,200 is still quite low compared to where the average fees the average clients will be paying in Australia. And we believe there's still some headway or runway for us to be able to increase fees in the coming years. Our staff headcount has been quite stable. Staff remains to be one of our key assets, and we want to make sure we are able to look after the staff and give them the support that they need, and hopefully they'll pay that back to us through their loyalty. Looking at the financials, we are not going to go through each line, but the But the icon that I like is on the last column, which is thankfully all the triangles are pointing upwards. That's the direction that we would like to have, and as a shareholders you would like to have. But if I take any of the metrics, operating revenue up 11%, underlying EBITDA up 20%, stat NPAT up 23%, we are definitely have gone in the right direction in last financial year. In fact, each of our business segments are performing quite strongly. Funds management produced a profit before tax 18 million. Financial planning has improved the profitability roughly by about 1 million compared to 2024, up to about 4.8 million. Platform administration 13.5 million. So all of these segments are performing very, very strongly. This slide shows a visual of how Fiducian shares have performed over the years, over the last 30 odd years compared to the All Ords. And All Ords, including the dividends, have produced a return of 275%, and Fiducian has produced a return almost close to about 2000%. This graph was done on 12th of August, where you can see their price was 11.4, and currently the price is a bit higher compared to that. So the outperformance will be even larger. Our dividend policy remains 60 to 80% we pay out on dividends of underlying net profit after tax, which is more of a cash profit for the company. In the last half, we paid a dividend of 24.7 cents, which will get paid out next week. And the full year dividend before franking credits is 46.6 cents. It's all fully franked. In fact, some of your long-term investors in Fiducian, in fact, if one of the investor had invested in Fiducian only $1,000 on 1st of July 2012, today with the current rate of dividends, there will be an yield of 44%. And as we saw, including the dividends, the return has been more than 2000% over this period. Board's target is to produce double-digit returns over the long term. And in fact, out of 25 years we have been listed in the stock exchange, we have been able to produce 19 out of 25 years, double-digit returns, consistent growth. A quick visual on how our FEMA has grown over the years. And this is going to be my final slide. I'll take a couple of minutes to work through this slide. This slide is not a forecast. It's not an estimation of how the revenue or profit could look like. It's more of a conceptual representation. So this slide on the left side of this slide, 2013 goes across to 2025. And we have got some solid bars and solid line graphs, but we have also got the shaded lines and the dotted graphs. So all the solids are the actuals that's happened over the last 12, 13 years. And the shaded are just the conceptual representation. So if I go back to 2013 on the left side of the graph, you can see the funds under management, administration, advice that we have. The FEMA was about 3 billion at that point of time. And the red line, which is the expenses, was roughly about a little bit less than 20 million, maybe about 18 million or so. And the revenue line, the green line, you can see was visually again about maybe 26 million or thereabouts. Over the years, the red line has grown. As our business has grown, the costs have increased. But the revenue, the green line, has increased at a far faster rate compared to the red line. So as a result, the 2013, the gap that we had between green line and red line, that jaws of growth or the gap has increased very much. Fast forward to 2025, when we have got a 2025 average FEMA was 14.3 billion. And you can see the difference between the green line and red line has very much expanded, which has flown through a much larger EBITDA shown in the horizontal bar chart.
The little black arrow is representing what the situation is about now. Correct. Which is very start to the financial year.
Yeah, that's right, indeed. So that was 31st July, and you can see that's about $1 billion ahead compared to what the average in last financial year. And fast forward to 31st August, which we haven't published the numbers, but it's certainly more than 15.2 billion. That's all I had to share, indeed. And very happy to take any questions, Mark, from yourself or from the floor.
Thanks, Rahul. Yeah, I got two questions maybe on the funds management business. One is there any thoughts of expanding the offering? You know, you've got, let's say, the 4 core funds and the 2 specialist ones. Is there plans to, you know, add in another product in there that, you know, is either getting requested by advisors in your own network or from the IFA side?
I can't think of any new products being asked for. So you've seen there, Mark, the diversified funds being presented there. About 65% of our money goes into the diversified funds because that's defensive and safe for the client and yet gives them growth. So each balanced fund or growth fund has about 27 different fund managers. And by that, we diversify the risk from any single manager, because what can go wrong for an advisor is when they advise a client to invest, say, in a single manager, and that manager doesn't do well, then they're getting cross-examined by the client and they're backpedaling instead of giving the advice. So, for example, as Rahul mentioned earlier, if someone invests in our share fund, there are 6 share managers. And at any one point in time, we expect 3 to 4 would do well and 2 may not do so well, or at least 2 will do well and 3 or 4 may not. But it reduces the risk for the client. And as you can see from our numbers for the diversified funds, in about 10 years, we're still ranked 2nd and 3rd out of all the fund managers that come to Australia from here and overseas. Now, you may see the numbers may look a little smaller, but in competition, but there were at least 80 to 100 to start 10 years ago, and many have just fallen out of the perch. Now, what we've also developed along this for the funds, Mark, and for your clients, are the separately managed accounts. And these are accounts which a member or client can invest themselves to select a particular portfolio, or an advisor can select a particular portfolio for all the clients. And we've now designed the algorithms and we almost completed the programming, which will be released, that a person can come in today and another client can come in after a week, but they will get the same portfolio and the same return on a dynamic basis. So what was happening in the past in Australia is they would choose, say, 10 shares, and then after a week or so, another client would come, but the share price would have moved. And they would still get equal weighting of 10 shares. And then down the track, they would then sell a particular share, move it into cash, and then try to rebalance so that most people would get a similar kind of return. But with what we've come up with, which will be hopefully launched pretty soon, there's no need to do that, and it will be a dynamic portfolio that delivers the results for all clients and gives them the same kind of return. So this is the new thing that is being followed by a lot of advisors called SMAs. And we're pretty much onto that with our own systems. Now, as you said, for external market, yes, there's always an external market. And it's a question of, do we stick to our knitting and grow the way we are, or we start spreading our wings and dilute what we're doing here? I think the focus we've got now is that let people who want to use our funds come to us. We have already got good results. And I think if we can get our advisors, like last year, Rahul said we had about 350 million in, with 77 advisors, roughly 6 million or 5.5 million a year from each advisor on average. There are some advisors who do 20 and there's some who do 2, as you know. But we've raised that to tell people they should be looking at 7 million a year now going forward. And so hopefully we get a larger inflow going forward. It started well this year. And also we've expected them to increase the fees for clients because we are very low compared to the market average. And the market average, Rahul, is about 4,200. And our average is about 3,200. So there's room for us because the service we give is excellent. We are very, very particular about the service our advisors give. And we have about 6 1.5 advisors for one support person, which is an extremely expensive proposition, but that's something I'm not going to give away, because that risk of giving, as you've read so much in the press about advisors doing the wrong thing, funds falling over, we can't take that chance. So it's an expensive proposition, but we want to keep helping our advisors and make sure they're compliant and they do the right thing.
And then,
What would
Rahul, I
you
think
want?
if I read your graph correctly on the funds management, you're on about 6 billion funds under management. Is that
Correct.
correct? And you talk about, obviously as you get scale, you can have further conversations on pricing with managers because you're bringing so much more volume. But I'm just wondering where that tipping point is. Do you need to hurdle the 10 billion thing to before you can kind of go back to managers and say, hey, look, we started here and now we've eclipsed 10 billion now, so we need to relook at the pricing structure. I'm just wondering where those conversations start to kick in for the managers.
Yeah, look, that's pretty much done its course quite a bit, and we just want to let the status quo remain and get more inflows and create our profitability from there. And of course, if we give someone $1 billion or someone, we'll be saying, look, I think we better stop paying you more fees because you're doing the same thing for another billion. Let's come to some compromise.
Okay. And then just on the advisors, I mean, we know there's a shortage of advisors in the whole ecosystem. A lot of advisors have left over the last like 5 years due to constant regulation changes, upskilling, education requirements, all of that. In terms of, yeah, I guess, trying to grow the advisors under the Fiducian flag, how hard is that to A, attract people on one side, but B, not lose them to, a competitor on the other side?
Yeah, well, good question, Mark. We usually don't lose advisors to the other side. There were a couple that we are short this year. One was a person who didn't complete his foundation SOAs in time, and we're very particular about compliance. So after about a year and a bit, the head of financial planning had a chat and said, look, man, you might join someone else who's not as difficult or as uh, uh, telling you exactly what you need to do, and they may be more lenient. So that and another lady broke her shoulder and her back, and we helped her out for a year. But those clients have now come into Fiducian, and she'll probably be retiring. So that can happen. But there's, I think, about 4 or 5 negotiations right now afoot for new advisors to come across. But our people are not that easy to let advisors in. I think they're a little too difficult, the financial planning people. They got to get a police check and reference checks and then look at their old statements of advice, their old records of advice, samples. What is the APRA record? What's the ASIC record? Are they fit and proper? Have they got any complaints or claims against them? And then on top of that, they send someone to go and see if the person's a culture fit for us, that they'll fit our culture. And on top of that, after they've done all that, then they say, we're going to give you an exam. So by the time people go through 60-70% of it, some of them say, look, it's too hard. With Fiducian, we just go somewhere else. But those who are seriously wanting to come across. The other way we can increase is that when we buy businesses and they have existing financial advisors, they may want to stay with us and continue that under our flag. And so we can increase there. But the idea is not so much to increase and build to 1,000 advisors like so many of the bigger groups had, and then come unstuck with the Royal Commission and all these things of compliance. We'd rather, I think, we can get about 100, 150 advisors maximum, and each one writes 7 million, 8 million net. You're talking about 1.2 billion of new money coming in. And even with our 70 advisors, there's very few large advisor groups who write the kind of volumes we write.
Okay.
So it's a question of whether you want many more advisors or you want more productive advisors, and we like the productive ones.
Indy, Rahul, we're just slightly gone over time, and I don't want to take up any more of your morning. And special thank you to Indy for making the time to join us. Unplanned but welcome addition to the presentation. And yeah, I will wish everybody a good rest of their Friday and have a good weekend. And we will be back with our next webinar will be at the end of September. We're going to focus on getting ready for the conference now in Sydney over the next week or two, and then we'll be back end of September. So watch on your inboxes for that invitation coming out probably the last week of September. And we leave it there. Thank you.
Thank you, Mark. Thank you, everyone, for spending the time listening to us, and we appreciate if any support you do give us. Thank you.
Thank you, Indy.